Hi, I'm John Byrne with Poets and Quants. We are here at UC Davis's Graduate School of Management for our Thought Leadership Series. Today we are speaking with Robert Marquez, who is a professor of banking and corporate finance.
That's correct.
Robert has been here since 2012. He's taught at Maryland, Wharton, ASU, that's Arizona State University, as well as Boston University before settling here. He has his PhD from MIT in economics. Welcome.
Thank you. Thanks for having me.
So, what inspired you to become an academic in the first place?
Well, it was somewhat serendipitous. I think this is true for a lot of people. After I finished college, I went to work for the Federal Reserve Bank in San Francisco. So I was kind of a Bay Area person. And I worked there with a lot of people that were doing long-term research in economics, long-term research in finance and international trade issues. And until that point, I really hadn't thought about the world of academia, the world of research, the world of doing a PhD, which I barely even knew what that was. It was just an interesting job at the time I took it. But it was actually my boss that he immediately said, okay, you should be thinking about a graduate program in economics. And that, a few years later, I wound up applying, and that's how I wound up that route.
Interesting.
Yeah.
Now, what was your dissertation on?
So my dissertation was on thinking about issues related to competition in banking. So financial institutions where information, we always think about information as being a very important component of what they do. They profit essentially by what information they have that somebody else doesn't have. And I was interested in thinking about the structure, the industrial organization specifically of credit markets. So thinking about banks that have information about their customers and how that can make it difficult for other banks to come in and try to poach those customers away. And so that creates a certain market structure which then kind of drives forward and has implications for the pricing of loans, for who has access to credit and those kinds of things.
That's fascinating because in a way, social media companies are operating on the same premise, aren't they?
Yeah, so there's a lot of talk these days about to what extent is the private information that these companies have and the control and access to information important for the ability of other social media companies to come in and their long-term success and who really owns the data. That's a big topic these days, yeah.
Now, Robert, what was it about banking that intrigued you?
That's another one of these strange, like serendipitous type things. I wasn't initially interested in banking. I came from, I was doing economics, but at the time I was doing my degree, banking itself was not so much of a topic in economics. It had moved over into business schools, where I am now, and in particular, it became an area of finance, much more so than an area of economics. I came at it from the perspective of industrial organization. I thought of myself as a microeconomist interested in topics related to competition, competition policy, barriers to competition, and how that's affected by information flows. It was really through discussions with classmates and professors and seeing other people's presentations that I realized that banking, credit markets in particular, were a very good sort of way of applying these tools of economics, of industrial organization and information economics.
So in all the years of research that you have done on the field, what would you consider to be your most significant discovery?
Yeah, that's always a difficult question.
Sure.
You have to kind of go back and think about like what came when and what inspired me in different topics. But one topic that the one that had the biggest impact that I can see is one that I worked in around the time that the financial crisis was happening, actually a little bit before. So I'd like to think about it as having helped explain the crisis, but unfortunately it was almost like published a little bit too early for that.
And by crisis, we're referring to
the 2008 like subprime crisis and
exactly.
the big extension in subprime
which a lot of people lay the blame on derivatives.
Yes, but a lot of that also was fueled by a tremendous increase in lending that took place, both on the real estate sector as well as like some small business lending. And I had been working on a topic related to how credit booms arise. So what leads banks to all of a sudden switch from being very conservative in their lending and keeping tight controls of their portfolio and keeping track of their customers, to maybe deciding, hey, let's open up the floodgates, lend to everybody we can, get as much market share as we can, and essentially, you wind up with this problem that maybe banks are overextended, maybe they have limited resources,
right.
Maybe simply their underwriting standards have gone down up front, and they wind up making worse loans. They have bigger portfolios, they have higher leverage at the same time, and this can lead to a substantially higher probability of having a crisis event, meaning, bank customers start to default, the bank finds itself in trouble, low capital, and winds up potentially being under receivership as well. And so we had thought about it from the perspective of like international crises. So one of my co-authors in this does a lot of work on international finance. And we had thought about it from the perspective of this kind of like balance of payments type crises. That's what originally inspired us. And they tend to go hand in hand with banking crises. And it was only, this paper was published in 2006, 2007, 2008 was really when the subprime crisis really got going. And I think that there's lessons from our work for that, even though we hadn't written it at the time, thinking about the subprime crisis specifically.
So what causes banks or bankers to loosen up the restrictions on lending? Is it competition? Is it greed?
Right.
Is it a combination of the two? What is it?
So I'm sure that everything you said is true. Okay, I am sure that there's a component of greed. Competition is a primary force in economics, and so we always think about competition as a driving force and an important component. My work falls into what, as economists, we think about as being rational frameworks, and all I mean by that is that the idea of greed is a human trait that economics doesn't do a great job of capturing unless I can demonstrate that it's fully rational, self-interested behavior that kind of drives this kind of greed component. But yes, I mean, we really, I've always thought about it as there's an element of competition that leads me to feel the need to, if I have some set of customers, maybe I need to steal some customers from you because the market is only so big. And if I can't steal customers from you, then I have to find other people that I might lend to. In some contexts, this has been referred to sometimes as a search for yield, this idea that there's poor investment opportunities out there and I just have to hunt to find more of them. But of course, doing that means a lot of times making more mistakes. Right?
And assuming greater risk.
And assuming greater risk, exactly. I want to get a bigger return, I have to be willing to put up with a higher risk.
And is that what fueled a lot of the lending to people who probably couldn't pay those loans?
I think so, I mean, my impression is yes. My impression is there's two components. One was there's been changes in the industry going on for a long time. Institutions have gotten bigger. They've gotten more highly levered. That's created a greater need for them to go out and look for these this search for yield, right?
And more deregulation.
More deregulation. That's part of what's fueled the growth in them, right? You look at like the financial services industry, and you look at banks specifically, and then you look at like commercial banks, right? And the commercial banks went from something like 16,000 banks in existence just in the U.S. in the early 80s. And you fast forward to like around 2000, you have half that number and probably less, 6,000, 7,000. I think that's roughly what we have these days. And so you've had this big consolidation, and you would think these institutions are getting better and smarter and bigger, but that's not necessarily true. What it means that now they have more resources, more capital to deploy, and more need to earn a return as well for their investors. And so you wind up with institutions that now, maybe as a small bank, I had to operate very, very regionally, very locally. I get bought by a bigger bank. My resources can now be used to compete with the next big bank that's around there. And so that actually can lead to an enhancement of competition.
And competition is also a function of power, influence, desire among humans.
It is.
I mean,
it is.
The reason why you want to be bigger and you want to earn more is you want to be able to tell the world, I'm better than you. I mean, is that really ultimately what it is? And Jamie Dimon, wants a chest thump himself.
Well, again, that's where I would say I'm sure that there must be a component of this. I think it's hard to rise to the top of any institution, much less a bank, without having a large ego, right? Without having a strong desire to plow forward, without having a tremendous work ethic, of course.
Yes.
And what I've been saying has made it seem as if competition is a bad thing, but
No,
but
it's a
that's
good
not.
thing.
It's a good thing,
Absolutely.
right? So competition is what gives us growth. It's what gives us, companies access to credit. It's what reduces interest rates for corporate customers when they're trying to borrow. All of these things are great aspects of competition. That doesn't mean that everything about it is good, right? Especially when it's driven by, you said greed earlier, right? Or the chest thumping desire, the feeling to want to have a big complex that I'm controlling. Then you can have some negative aspects associated with competition. And my research has kind of focused on those more negative aspects, but definitely there's a strong positive side, of course, to competition.
If competition works,
Yeah.
why is the interest on credit cards for consumers as high as it is? I mean,
Right.
the interest on credit cards today is what the mafia used to get
Yeah.
a quarter of a century ago.
Yeah.
How can that be? Is competition not working?
I think I don't have a strong view on this, I'll be upfront. I know some research, in fact, of some of my colleagues here at Davis, as well as people I've worked with in the past elsewhere, and their view is competition, when you look at the retail sector, and when you look at the household sector in particular, like for credit cards, competition is not really working. That people, households, individuals don't make very good decisions around their own finances. They don't spend the time shopping around that they probably would need to in order to figure out how competitive that landscape is in the first place, and which suggests that competition just really isn't working for them. They latch on to one thing, and once they have that, they don't really want to switch away from it.
Yeah, it's interesting. So these interest rates are blamed then on low information consumers.
It's kind of like behavioral problems or search frictions that arise from whatever it happens to be. Maybe you have a family that you're too worried feeding your kids than you are to searching for a better interest rate. Even though that would help you, of course, both in the long term and the short term to lower your cost of borrowing, reduce your monthly credit card bills. But people don't do that, perhaps because they have other things that they're doing. That part's the part that's a little bit less clear, but there's all these behavioral aspects to why. And it doesn't seem like competition does a great job.
And why there's not a company that can come out with a 10% interest rate on a card is a puzzle to me. Because at 10%, you can make a good amount of money, as long as you make sure the credit risk is right.
If you talk to the credit card companies, my understanding, whenever you see an interview of some kind, they say that credit cards, for a lot of the larger banks at least, are not tremendously profitable for them either. So what happens is, the claim is that the good customers tend to pay off their bills all at once. And so they're earning almost nothing from them other than the transaction, the clearinghouse costs from them, what they get basically from the merchants.
Yes.
And it's the customers that are much more likely to default that are the ones that wind up rolling their debt over and paying those high fees. So their argument is they're not actually making any kind of a usury rate or any kind of extraordinary cost on or markup on those customers, and they're basically covering their expenses. I don't know that I necessarily think that's true, but I think that there is some kind of segmentation in the market in terms of who tends to roll over, and it's exactly those customers that would probably benefit the most from the introduction of this company that you have in mind, that would half the cost of financing for these households, and they're the ones that are probably the most locked in and the least willing to search out best opportunities for themselves.
Yeah, interesting.
Yeah.
Now, Robert, you've also done a lot of work on M&A.
Yeah.
What have you discovered there?
So my work on M&A has focused a little bit on primarily acquisition prices. So thinking about, at what price will a transaction take place? And I mentioned earlier, I'm a microeconomist by training, and so the lens through which I've looked at M&A has been primarily through the lens of, okay, what does microeconomics have to tell us? And specifically, when people look at M&A, On the finance side and on the economic side, a good way of thinking about this has been, okay, if we come back to competition,
Sure.
there's competition to buy some assets, to buy a company, which is a collection of assets. And how should we think about that competition? How should we model that competition? We want to understand what are the forces there that might lead to higher acquisition prices, higher premiums, lower premiums. And a good way of doing that is to use this idea of competition. And the way economists tend to view competition is through the use of auction models. So it's like a firm is being auctioned off, and you have people interested in buying it, so they make bids. And we have a lot of auction theory that gives us some guidance in terms of how to think about how that bidding process will ultimately lead to a higher or lower price. And so my work has kind of focused on that auction part of how acquisitions are done.
Now, generally, companies are acquired based on a multiple of earnings of some kind, right?
Yeah.
And then you get into the premium area if it's a strategic acquisition, or if there's competition with other firms to acquire.
That's right.
Which is the ideal situation if you're selling.
That's right.
What have you actually discovered about this whole process of buying and selling companies?
Yeah, this kind of question comes up a lot in one of my classes. So I teach a segment on M&A, and students always come to me with examples from their lives that'll say, oh, I'm working for the family firm, or in my company, or my uncle's company. He does some acquisitions, or my aunt does some acquisitions, and they always look at it as, he says that he'll never pay more than 3 times the company's annual earnings. Or somebody else will say, no, but my aunt used to do this thing for, dental offices, and they would pay 6 times quarterly revenue or something like this, right? And so there's all these rules of thumb. And I always want them to take a step back and ask, well, where are these rules of thumb coming from? And is it at all surprising that when I look at dental offices that the rule of thumb is very different than when I'm looking at toy stores or tire shops or these kinds of things, right? So I get them to try to think a little bit about where are these rules of thumb coming from, and focus on the valuation side of it and say, okay, what do we know? There's a company that has some assets. What we'd like to do is value those assets. But the value of the assets that we might get isn't necessarily what we're going to have to pay for those assets, right? So now we start thinking about, okay, who else wants to buy those assets? Oh, well, if there's a big fish out there trying to buy these assets, then I'm going to have to either pay a higher price, or that might lead me to back out entirely and let somebody else, if it doesn't seem like this is something that I'll be able to do, right? So we start thinking about these kind of competitive forces that shape the prices that we might observe. And then once we get there, to think about, okay, how can we now use what we have here to kind of back up and say, let's go back to those rules of thumb. Where does the 4 times annual revenue rule of thumb come from? Well, it comes from thinking about a profit margin that probably historically been average for this industry, and how revenues, and you think about the profit margin, what's left over, and then what does that translate into a valuation, and that's where we wind up with the rule of thumb that they might otherwise have.
Interesting.
Yeah.
So what do you like most about what you do?
I like the thinking part of it. I think this is probably a common answer that researchers will give you, but the job is create knowledge and disseminate knowledge. And the knowledge creation part, to me, has always been fascinating because it's very open-ended.
Yes.
Right? Like I know when it comes to disseminating, I know what I'm supposed to be teaching, and I try to pepper in sometimes new findings in the field, whether they're my own or somebody else's, into the classes. But I know what I want to teach. When I'm trying to figure out what I'm going to research, I don't really know. So one idea sometimes if I'm lucky, will lead to another, which will then lead to another. But a lot of the process is sitting down, thinking through ideas. And my wife sometimes jokes about this, that a full day of work might be me staring at the computer, typing like 3 lines, and that's about it. And then it's like, oh, that was a long day. And she wants to pull her hair out because she feels that I've done nothing. But it's true. For me, making progress on my research is sometimes simply having come up with a new question. Not even necessarily how I'm going to address that question, but just having it in mind. And that might take me a day, might take me a week, might take me a month. And that's what co-authors are particularly good for, is bouncing ideas off of them. You want to work with other people who will give you some perspective as to whether what you're doing makes sense or not. But that's the part I like the most.
And then your other role is teaching it.
The other role is teaching, yeah, absolutely.
And is that harder than research sometimes?
It used to be. It used to be. When I was, I'll say when I was younger, when I first started, coming particularly from economics, the distinction between economics as a field of study and finance as a field of study are not very big. But the distinction between teaching economics, which I did a little bit when I was a graduate student to undergraduate students, is quite different from teaching students that are doing a master's in business administration, who have a very different perspective on, they want things to be much more applied. They want things to matter to them. They want to be told, why is this relevant? I don't care about learning some formula if I'm not going to be using it, or what am I going to be applying this to? And so the first few years when I started at the University of Maryland and I was teaching there, I found the teaching part pretty challenging. I had to do a mindset change, moving from my kind of ivory tower of research to how do I make this relevant and interesting for the students. Now I guess I've become a bit of an old hat in this, and I quite enjoy the teaching part of it. I feel like it's an opportunity for me to not just tell them some of the things related to M&A, related to banking, related to whatever it is, but also to try to take some new ideas that are out there that people are researching and think about, why is this relevant to like an MBA student? And not every idea is, I think, not right away. I mean, we hope that every idea will eventually become relevant, but the first iteration may not be, right? But there is stuff out there that people should care about because it's interesting and it informs the world, and it probably informs their world, what they might do within their own jobs.
The other thing is that in PhD programs, you're not taught how to teach.
You're not taught how to teach.
You are taught how to research.
Yeah.
And explore a topic in an innovative way, perhaps, but you're not really taught how to teach. So when you come out of a PhD program, those early years could be quite challenging, as you found yourself.
Yeah, no, exactly. I mean, I won't mention the person's name, but the worst class that I had as a graduate student was from a professor that wound up going on to win the Nobel Prize in economics, and it was just terrible. He couldn't really explain, even to a set of graduate students who were interested in the research part of it. He had a very difficult time conveying it in a useful way. Brilliant individual, of course, obviously very influential work, but not necessarily the best at conveying that. And you really don't get almost any training. To the extent that you do, you get a little bit where you're a teaching assistant for somebody, which probably means grading some papers for the most part.
Sure.
And it becomes a little bit of trial by fire when you, and that's why I struggled a little bit the first couple of years. But. So
Robert, what has your work and how has your work informed your life?
Yeah, I think this is a great question. It's a hard question to answer. I think it's made me more than anything. I've learned to recognize that the world is kind of imperfect and that there's a lot of questions out there completely unanswered. And so I think that this realization has informed my research, and I think my own research has then kind of fed back into this recognition on my side that a lot of answers are just not out there, and we kind of have to still progress with limited answers, limited information, not knowing who we're competing against always. Just kind of recognizing that the world is imperfect, and there's lots of answers to questions along everything, not just economics, about life that we just don't know, and we're just going to try to learn as we go along.
So true.
Yeah.
Well, Robert, I hope the next time you're in front of your computer and you're staring and you're thinking, your wife doesn't pull out too much of her hair.
Hopefully not. We'll see about that. I don't know if I can convince her that way, but we'll try.
Robert, a pleasure. Thank you for joining us.
Thank you. Thanks for having me. Appreciate it.
All right, you've been watching our series on thought leadership with UC Davis's Graduate School of Management. We are exploring the ideas, the passions, and the motivations of some of the top professors here. Join us for the other parts of our series. Thanks for watching this one.